am super excited to have Elaine Stageberg from Black Swan Real Estate here with us. So many of you may already know Elaine, but she is like a force. She is a trained psychiatrist. She also founded Black Swan Real Estate with her husband, Nick. And Elaine has one of the most just amazing stories and backgrounds of anyone that I've met throughout this entire journey in terms of starting out investing in real estate as a resident and even reaching financial freedom through real estate by the end of training, and now has really turned her full focus to helping other physicians achieve the same thing through real estate, and runs Black Swan and does it in just a very transparent, open way that I think is amazing. So I'm super excited to have her here. And like I was telling her before, really, she's one of the few people I would trust to give a talk like this, which is, as a limited partner, as someone investing in deals like this, how do you tell who's a good, honest operator from who's not? Because it's not like, I always say that it's not like whoever in the financial world is taking the Hippocratic Oath. We have to learn who to trust, and that means we need to learn how to do some of the underwriting, the vetting ourselves. So that's what Elaine is going to go through today. She's shared a great resource as well, and is going to be kind of going through that, and we'll have plenty of time for Q&A as well. So I encourage you to ask questions as they come up, throw them in the chat. In the chat is the download if you don't already have it up. And with that, I will pass it over to you, Elaine.
Yeah, absolutely. Thank you. Thank you for that introduction. Would you mind pinning my screen so that when I share screen, it goes? That'd
Yes.
be super helpful. So welcome everyone. You basically learned, quite a bit about me there in that introduction. Thank you, Jordan. Excited to be here. I did just put a PDF in the Zoom chat. So if you want to grab that, you'll have that. That's kind of our outline for what we'll go through this evening. And then if you're watching this via replay, I'm sure that'll be attached to the replay email as well. And as I was thinking about, putting this together and kind of conceptualizing this framework, I'm a big believer in analogies. I think that really helps us to just interpret things from, one industry to the next or one situation to the next. And I think of choosing a general partner in a real estate investment almost the way a lay person would choose a physician, not how you as a physician would choose a physician, maybe for your own patients or for your own family, because you know the lay of the land, right? And you would almost certainly just go straight for referral, right? Even if you were looking for someone cross country, you would be, contacting people you went to residency with or fellowship or trained with or met at conferences and asking, who is the best ENT in this area or who is the best person for this specific condition. And it's kind of like that in choosing a general partner in a real estate investment. It can be very, very challenging to determine who knows their stuff, how long the track record is. Are they actually, is their track record actually indicative of their whole history? Are things eliminated from the history, those sorts of things? And so to some extent, the closer you can be to a general partner through referral, following them for quite some time, investing small amounts with them, and then building over time. Anything you can do to really substantially build that relationship cuts through all that noise. There's so much marketing spend. There's so much obfuscation in this industry. It can be pretty challenging. And so I'm going to do my very best to put our arms around this of how you can make wise decisions as you are choosing a general partner. I'll also mention that the way I think about choosing a general partner is pretty different than you might hear in other presentations. And, much like medicine is an art, there's a lot of art in investing as well. You might hear other presentations that really focus on things like IRR, internal rate of return, or equity multiple, or how sophisticated is their team, or those sorts of things. And it's my belief that choosing a general partner is much more of a qualitative decision than it is a quantitative decision. Because just simply the way the financials work in real estate, it can be very easy to be very misleading in real estate, either accidentally or intentionally, if someone is only looking at the financials. Because real estate is generally valued based off of what is called net operating income, which is all of your income minus all of your expenses, multiplied by a capitalization rate. Even something like, say, a $20 per month rent swing in a 100 or a 200 unit community can have a substantial change on the overall value or, projected value of that building. And so, sometimes the misleading may not even be intentional. I am in no way saying that, just everyone in this industry is dishonest or those sorts of things. But the numbers can be so hard to pin down because there's so many different numbers and how things are evaluated in real estate. So the three things that I wrote down, this unfortunately didn't make it to the worksheet because I was just writing these notes down as I was preparing, just 20 minutes ago, is kind of qualitatively, as you are making a decision for who to invest with, you want to be thinking about choosing someone who will steward your capital very well, someone who you are choosing their decision-making algorithm, and someone with whom you have general alignment on that specific investment. So a steward is someone who puts your needs before their own, thinks about your needs, subordinates their own desires, to the needs of the whole. When I think about decision-making algorithm, I think about how, just like choosing a physician, right? We hope that things go well. We hope that no one has an allergic reaction or a bad side effect to a medicine, or that a surgery, doesn't go poorly. But these things happen. Same thing in real estate, right? Not everything is always completely perfect in real estate. And of course, when someone is doing kind of the general presentation on a deal, they're likely presenting, some of the best scenarios. If we can do this renovation and raise these rents and, decrease these expenses, and we are able to either, refinance it or sell it at this particular cap rate, right? They're presenting kind of the best case scenario, but you're really looking for the decision-making algorithm. What happens if they can't hit their target? What happens if the market shifts? What happens if 2022, 2023 happens when rates went up faster and further than anyone predicted, right? Faster and further than, in a generation. What happens if regulation changes? What happens if there's a natural disaster? And you may not necessarily hear them specifically answer for every single one of those scenarios, but as you're listening to their presentations, you're doing an investor phone call with them, you're looking at their brochures, talking with referrals, those sorts of things, be training yourself, be attuning yourself for thinking, what is the decision-making algorithm of this person or this team? And is it an algorithm that I want to be a part of? And then what I mean by general alignment is you can really feel like someone would be a great steward of your capital. You can really feel like, man, you really appreciate their decision-making algorithm. You think they're going to make good decisions, whether it's good times or bad. But if they're going for, say, a very low cash flow, very high appreciation play, and you're looking to retire in the next year and you're really looking for cash flow, you may not have alignment on that particular opportunity. So there's that alignment of, are the specific investment goals for that specific deal aligned with the financial goals that you have? So there's kind of three things that sort of frame the way I think about these relationships. So I'm going to pull up the PDF here, and at times I'll share the screen so that you can see that if you're watching on your screen or your phone, and then at times I'll just drop it down so that we're more conversational style here. But let's go ahead and start to take a look at it. So this is the 7-step framework for evaluating real estate general partners. You can print this off. You could essentially create like a file for every general partner that you're assessing over time. And what you'll see here is that it very much follows the theme that I just spoke about, that you are looking for qualitative information in the conversations that you're having with them. Either it's one-to-many, like it's a presentation that they're doing, or you're on a phone call with either the sponsor themselves or their investor relations team. You're reading their website, their brochures, those sorts of things. And most of what you're going to see here, there's a few things here that are deal specific, but mostly here we are focusing on what's called the jockey. So in investing, there's the idea that, do you bet on the horse or the jockey? Betting on the horse is betting on that specific deal. You believe in that market, that specific community, the business plan. the local dynamics, all of those sorts of things. And then betting on the jockey is you believe that that general partner is going to take care of that deal no matter what. Good times and bads, ups and downs, unexpected things. And it's really my belief that betting on the jockey is the way to go, is the wise move when making an investment decision. It's my belief that a good jockey can make a ho-hum horse perform very well, and a bad jockey can have the best horse with the best pedigree and the best health, and be predicted to win and completely mess it up. So as we're going through this list, we're really thinking about that jockey mentality and how are you evaluating that relationship. So you'll notice this isn't, the 7-step framework for evaluating a real estate deal. It's really about evaluating a real estate general partner. And in each of these 7 sections, I have some green flags and some red flags. I really believe that as you are evaluating a general partner, you want to follow their emails for quite some time. Go to some webinars, deal specific webinars, educational webinars that they host. At Black Swan Real Estate, we host a quarterly performance update for the entire portfolio. And you want to get on the phone with them. That to me is a huge thing, is are they accessible? Can you speak to them? Can you speak to, at minimum, an investor relations team? And as you're going through that due diligence, you can, essentially kind of go through this list. I've done thousands of investor calls over the years, and I can tell when someone is running a list. And I believe in empowered investors and empowered prospective investors. So I never fault anyone for having a list or any of those sorts of things. But I can tell when someone is running a list because they might ask things like, have you ever filed bankruptcy? Have you ever had a criminal charge? Do you have any judgments against you? Like all, very important questions, right? Chances are high that if someone is a criminal and has a judgment against them, they're probably also a liar. And so they're probably just going to lie to you right there on the phone, or have some sort of, opaque legalese sentence, right, to kind of work their way around it. So I think it's important that you're in conversation, that you are in relationship, right? You're really going back to that mentality of, is this a person who will steward my capital well? Is this a person who I believe in their decision-making algorithm? And do I have some general alignment on this deal? So let's first look at track record and experience. I think this one is particularly important in the physician space. This happened, across all industries, right? Where there's, high income, high net worth individuals, where through COVID, when there was a lot of money in the market and deals were relatively easy and interest rates were very low, a lot of people came into being a general partner because there's a lot of way to make a ton of money on fees. And so they, maybe owned, one single family home or a couple duplexes themselves or something, and then immediately started raising, large amounts of capital. And it's really important to look at someone's track record. Some of that has kind of tamped down over the last couple of years as the market has become much more challenging. Some of those people that kind of came into the industry very quickly have since left the industry. But you want to ask, how long have they been doing real estate investing? What is their overall trajectory like? Just like in medicine, I like to see a trajectory of escalating responsibility. So in my own trajectory, I first started investing with my own capital. My husband and I did that for many, many, many years. Then we started working with joint ventures, very small groups, 2, 3, 4 other partners. And only after we had done that for about 10 years did we first launch our first private equity fund. And then we've been in that private equity fund phase of our real estate investing career for about 6 years now. But ask about, what are your specific past deals? Go all the way back to hear that origin story. How did they first get into real estate? Ask about their performance in tough markets. And again, what you're looking here for is the decision-making algorithm. Do they take personal responsibility? Do they show the ability to problem solve, to pivot, to deal with no's, right? Maybe their business plan is to have a sale in a certain year and they weren't able to make that happen. Well, what did they do? How did they handle that? How did they steward their investor capital? Did they eventually get to a sale? Did they do a cash out refi? What did they do to handle that? And really look for a narrative that makes sense. You should be able to describe to your spouse, a friend, a coworker, anyone, I'm thinking about investing with this person or this group because they have this history. And it should be very knowable. You should have a clear understanding of their track record and the value that they've created across their past deals, and then how you're going to be a part of the value creation for their future deals. And then you'll have this up here that you can pull that up on your screen or your phone. I'll stop the share for just a little bit so we can be kind of more conversational here. Red flags would be things like very vague claims, right? Like, oh, I've been an investor for 10 years, or I've been building a portfolio for 5 years. Well, what does that mean? Right? Think about a surgeon. A surgeon can be operating for a year. Well, how many cases have they done? Right? It's a very different. Are they incredibly part-time and they're operating a few hours a week, or are they full-time and they're in the OR, most of their working hours? So thinking about hearing that, like, what are the specific deals? What are the specific history? And then no proof of syndications or exits. It's okay for someone to be new to the industry. Everyone has to start somewhere, right? We had to have our first private equity fund offering after we had done those joint ventures for many years. So it's okay for someone to have their first deals, and it's even okay for you to invest in someone's first deal if you otherwise know them and understand the story, and maybe they came to you via referral, or you have a closer relationship with them, so you know their character. But you want to have some proof of what they've done. Have they invested their own money? Have they worked in smaller partnerships? Have they had a smaller role in some other deals and now they're going on to launch their own deals? You want to look for that proof. Just like if you were, trying to choose a surgeon, right? You might say, how many of these cases have you done in your career? Tell me what those have been like, and how do you handle it if something goes awry, right? You'd listen for that narrative, even if you're not a physician, or even if I've never operated, right? I'm a psychiatrist, but I could listen for, does this sound like someone whose decision-making algorithm I can appreciate? That, of course, we hope things go well, right? If I'm the one that's the patient in the operating room, but I really want to know, what's their history? How do they handle hardships? And what is their decision-making algorithm as they're going through that? That's part one of our 7-step framework. Next up is evaluating team composition and expertise. Real estate is very much a team sport, all the way from the general partner, you can kind of think of that person as the quarterback, they're the leader of the team, all the way to things like the housekeeping staff and the ground staff and everyone in between, legal, accounting, compliance, property managers, leasing agents, you name it. We are incredibly vertically integrated at Black Swan Real Estate. So we not only own everything that's in our portfolio, but we manage everything as well. We do that because we believe that the team is so important. So what I've seen in the industry is there might be, maybe some poor outcomes happening in a particular deal, and the general partner will say, well, the property manager hasn't had their eye on the ball, so we're changing property managers. And it's like, well, like, ultimately you're responsible for that, right? So we just step in and say, this is our property management team. We take full responsibility for them. We're the ones leading our leasing team, our maintenance team, you name it. That's pretty rare in the industry. You don't necessarily always have to look for vertical integration. I'm a huge fan of vertical integration, but you don't necessarily have to have vertical integration. But you want to hear that they have a team. Who is their legal team? Who is their accounting team? Who is the property manager? What are the boots on the ground? How close are the general partners to that actual community? Understanding that there's clear roles for the key functions in that overall real estate ecosystem. Looking for co-invests meaningfully, including debt. So let me describe what that means. In many larger deals, say like 10 million or higher, there's two types of debt. There's full recourse debt, which means that borrower is completely responsible for that debt. Might be like the same as like the mortgage you have on your personal home. You need to find a way to pay that mortgage, whether it's from your income, or you need to sell some stocks, or you need to borrow some money from a friend, whatever it is, you are responsible for that mortgage payment. If you don't make that mortgage payment, the lender can not only foreclose on the home, they can sue you personally for your future wages and for your other assets. In contrast to that, non-recourse debt means that the person who is borrowing has no legal obligation to service the debt outside of the asset itself. So if for some reason the debt isn't being paid, the lender can take the asset, but they can't do anything to the actual, owner or general partner. I think that it's very important to know, is your general partner signing full recourse debt? How much are they co-investing in the deal? And the reason I think it's important is if a general partner has very little money invested in the deal and they have non-recourse debt, which is very common. I would say that is probably the extreme majority of real estate deals. That's their underlying structure. And things go poorly. They truly have very little to lose. They might lose some reputation. They might lose some time. With the way fees work, they may not actually lose money because they may have long taken an acquisition fee and they've been taking asset management fees, every month all the way through, and then things start to go sideways, and then the project goes under, and maybe there's a foreclosure or the bank takes it back. So they may not actually lose money. Conversely, if they're investing in the deal and they're signing full recourse debt, that tells you that they really believe in it. That tells you that they're pledging, their personal balance sheet, their personal income to say, if this property can't sustain its own mortgage payments, that I'll step in and take care of it. Kind of like what I was saying with vertical integration, and kind of the theme here that you're hearing is not everything is like perfectly black and white. I'm not saying if there's non-recourse debt, don't invest in deal, because a lot of times, particularly based on the size of the debt, there may be no full recourse debt available out there. Maybe that all of the options like Fannie, Freddie, or HUD, they're all non-recourse. But when I say co-invests meaningfully, asking about debt is a critical piece to understand as well. And then I also prefer a person who has a full-time syndication focus. I think that's how you develop expertise. I think that's how you're in the market day in and day out. You get all of those repetitions when in good times and in bad. There are plenty of people who do investing as a general partner rather part-time, might be, say, a physician, and then they raise capital for a larger group, and then they're kind of the intermediary. So the value that they bring to you is that they have some real estate experience. They're vetting the deal. Maybe they're traveling to the deal, doing a deep look at the financials, meeting with property management and legal and accounting and those sorts of things. So they can bring a lot of value to the deal. I would just say that in general, the more someone is in this industry, kind of, on the spectrum from not very much at all to their full-time focus, just the more repetitions they have, right? So going back to our first part, where we're looking at not just how many years someone has had in the industry, but the specific deals that they've put together over the years. Obviously, they're able to put together more deals if they have more time in it. And then a red flag would be no contingency if the lead sponsor is unavailable. Very important to think about if you're essentially investing in someone's decision-making algorithm, right? If you espouse that philosophy that I set forward at the beginning of our time together, you want to know, well, who's making decisions if that sponsor's not available? If they're ill, if they're incapacitated, if heaven forbid they die, are there other general partners? Is there a board of directors? Are there contingency plans if that person is unavailable? Is there a succession plan? To give an example from our company, we have a trust that would go into place and would automatically take over the portfolio. And it's made up of a 7-member board of directors, 6 of whom are hand-chosen real estate professionals, and the 7th of whom is a professional trustee. That's all they do is they steward large trusts, and that person would essentially kind of serve as the chairman of the board, would be the tiebreaker if those 6 real estate professionals disagreed on any one thing. It's an important question to ask. It's often the kind of thing that may not come up in a presentation, because just in the interest of time, presentations often focus on what's the name of the community, what's the purchase price, how many units, where is it, what's the business plan, right? There's only so much you can fit into say an hour long presentation. But that would be a great question to ask when you're doing a phone call and you're vetting the general partner is who makes decisions if you're unavailable? What's the plan if, heaven forbid, there was incapacitation or death? Again, we know that, so well from medicine that it happens more often than we think it might. So having a plan for that's important. Third up is alignment on investment strategy and market selection. And I'll just pause and ask if there are any questions before I go over to that one. Happy to take a breath and allow a question if anything's coming up. You can also pop questions into chat, and I'm kind of keeping an eye on that. And if I see questions come through, I'll either answer them right in the moment if they kind of fit into where I am, or I'll make sure I get to those at the end. But
Elaine, one thing I actually wanted to ask, because I see it happen a lot, and you touched on it, there's a lot of people who will raise money not for a deal necessarily they've sourced themselves, but as like a co-GP. And I think that's always like a little bit of a gray area because you're never quite sure. Sometimes I see people who are not really upfront with that. They'll say this is my deal or this is a deal I'm
Mhm.
using money for, etc. Other times you'll see even when they are upfront with it, it's something where if depending on how much they've invested in it, you're never sure how much they truly believe in it or how much they've truly vetted it or how much they're just trying to, raise money so that they can collect on fees and stuff like that. How do you feel about that? Is that something, you're like kind of stay away from? Is it something that you go deal by deal? Can you talk a little bit more about that?
Yeah, that is an excellent question. A little further down, actually number four. So we're on number three, but number four is where I talk about fees. I probably should have led with that because that's like the story of a general partner.
Yeah.
But you're absolutely right. A lot of people do, raise capital, and they're one of many people in the general partner team for larger deals. And those people can bring a ton of value, right? They get to know the lead sponsor very well. They do a very deep dive into the financials. They're doing site visits, they're doing ongoing site visits. So the things that I would look for is, first of all, asking them point blank, what is your fee structure, right?
Mhm.
If it's very heavy on things like acquisition fee, that would make me pause of, okay, interesting. So this person's very heavily compensated just for closing the deal,
Mhm.
right? That's not where the outcome comes, right? The outcome comes at the end when investors are taken care of. Um, and then I would say another thing I would look for is a person who's flittering from deal to deal to deal, right? They're
Mhm.
doing one multifamily in Dallas, Texas with this operator, and then they're doing a mobile home park in North Carolina with this operator, and then they're doing a self-storage with, in Jacksonville, Florida with this operator. And that would make me wonder why. Why aren't they developing a sustained relationship where they disclose? I am a general partner and I work with X larger firm. I'm still a full-time physician, or whatever, like whatever the honest story is. But I've invested with this group. I believe in them. I've visited the property. I've built relationships with them over, months and more ideally years. And I continue to work with them. Again, not to say that there can't be diversification, but extreme diversification makes me feel like someone's just chasing fees versus building a real relationship with a larger group and being fairly committed to, either one larger group or a small number of larger groups that they build organically over time.
Yeah, that answers my question great. And that's always I also saw, is around COVID when the rates were super low, like you were saying, and all of a sudden everyone was like an operator. But I saw a lot of people getting into it and then realizing, oh, sourcing my own deal is kind of difficult. And then almost kind of jumping on with these other larger operators, but not necessarily um, being savvy enough or interested enough to do their own due diligence, and where a lot of investors, it seemed like, were led astray and then got hurt by
Mhm.
adjustable rates and capital calls and things like that. So no, thank
Yeah.
you for
Yeah.
going a little bit more in depth on that.
Yeah, one of the very first questions I would have, like, let's say you were, one of those people and you were pitching me a deal. I would say, Jordan, tell me about the community. And I would really be listening. Has he visited it?
Hmm.
Is he telling me about the landscaping and the trees? And oh, I met this resident and I met the maintenance guy. And while we were there, they were bringing in new appliances. Like, just have you been there, right? Versus the stats that come from an offering memorandum. It's this
Yeah.
many units and this, right? And asking like, what's your plan, to stay on top of this? Um, there's kind of a joke in the industry of like how many times is an individual door counted, right? When someone says I have this many doors or this many assets under management, like we have 450 million, for example, like how many times is that counted by so many different people? It's a huge pet peeve of mine when it might be a $100 million acquisition. So maybe it's a $25 million raise, and someone might bring $1 million to that raise. And then they'll say, well, I have a $100 million portfolio. Well, that's maybe sort of like, I guess I'm in the mood to talk about surgery tonight, even though I'm not a surgeon, maybe because you are. But it's kind of like like a surgical tech saying like, oh, well, I operated on a patient today. No, like you were an integral part of the team. You had a role. You did not do the surgery, right?
Yeah. I think
Like
that's
really
even,
listening for those
yeah,
nuances.
exactly. And it's like, it's almost even too, some people drive me nuts because like a surgeon or someone who just came out of training is like, oh, I did 500 of these surgeries. It's like, yeah, you've scrubbed in on 500 of those surgeries, but you still have to tell,
Mhm.
look, I've done a lot of this. But I'm fresh doing it myself. And, um,
Exactly.
yeah, and I think too, you always, I mean, the analogy I always give for investing in like a syndication or something like this is, again, you're handing someone else your money and trusting them with it, like you said, to be a good steward. The more degrees of separation you get from that, the more chance there is of something happening. If you're handing someone else your money to then hand it to someone else, anytime there's those kind of more degrees of separation or depersonalization, you really, really want to make sure that these people are investing it well. So yeah, awesome.
Yeah. Yeah. Excellent. Really, really good question there. Let's talk about aligning on investment strategy and market selection. Some of the green flags there would be a conservative business plan. It is so easy to promise the star and the moons in real estate simply because of the way real estate is valued, right? It's valued on NOI and cap rate. So, let me do the math real quick. I should have this like memorized by now, but let's say it's a 200 unit community and they say they can raise rents by $25, right? I'm not even saying that they say they're going to double rents or anything like that. Just simply $25. That's $5,000 a month multiplied by 12 months is $60,000. And let's say they're in a 5 cap market. That would be a 20x multiple. So that would raise the value of that asset by 1.2 million. Pretty substantial number, right? Even if we're talking about, a $50 million deal or a $75 million deal, something that sounds really simple. Oh, we're just going to go in and raise rents $25 and then it's going to lead to, this valuation and we'll have this sale. That's why I'm a big believer in focusing on someone's philosophy and their character and their decision-making algorithm and really focusing on a conservative business plan. Have they done this before? Does it make sense? Are they stress testing for what if they can't hit those rents? What if the renovations go over budget and over time, which they always do? That's just like part of the process. And is there a clear understanding that you can understand and describe of how they are adding value to that community? That doesn't necessarily mean that they have to be doing renovations, but what are they doing differently from the existing ownership? Are they managing it differently? Are they marketing it differently? Are they going to do some physical renovations? What are they doing differently so that they're stewarding that community to increase the value of it, or at minimum to sustain the value of it? And then a clear risk reward balance. It was very common during the pandemic it would just drive me crazy that every deal was magically a 17 IRR. Like I would just wonder, like, does everyone else look at this and say, I wonder how like every deal under the sun, all of them pencil into, to a 17 IRR, because that was the magic number that like got investors to move, got investors to write checks. Um, Are there conservative assumptions based on the hold period, what the eventual exit will be, what the sale or the refinance will look like? The longer the hold period, the safer it is. That's just kind of the nature of real estate investing. If you hold something for 10 plus years, you're probably going to have a pretty good outcome. If your plan is to flip something in, 3 years, 5 years or less, there's more risk there. So really understanding how are they interpreting risk. Risky deals may be a part of your plan, right? When we think about that threefold thing of someone who is a steward of your capital, you agree with their decision-making algorithm, and you have alignment with their deal, you may want something that's very risky, right? That's how you want to invest that specific set of dollars that you have, but you just want to make sure that you understand that. And then red flags would be mentioning like hot market. I saw that so much during the last several years. The Sun Belt, the Sun Belt, the Sun Belt, Austin, 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 the Carolinas, the Carolinas. Where there is boom, there is often bust. Where there is hype, it often goes away. Looking for someone who knows a market, who has a relationship with that market, who maybe is a bigger player in that market so they can start to get some economies of scale and efficiency and reputation and those sorts of things versus chasing like the next hottest thing. Like the Sun Belt was a big boom through COVID, and now it has really receded in terms of rental rates, and vacancy has gone up. So looking for something that's slow and steady or steady and stable versus something that's like a boom or bust market. And then another thing that I think is a pretty big red flag, I would like put a star next to this one, is vague or shifting strategy. So similar to the example I gave with Jordan's question of how would you evaluate someone who is, generally kind of serving as raising capital in the deal. I would be weary of someone who is raising capital for this mobile home park over here, but this multifamily over here, but this self-storage over here, and this oil and gas over here. Same thing if they're the owner and the operator themselves. There can be diversification, and you can take a skill set and apply it to other things, right? You can take that operational excellence and apply it to other things. The thing that I see in today's market, I've given some examples of, some red flags through, say 2020 to 2023. Let's talk about today, 2025 going into 2026. The thing that I see today is someone who has never done things like hotels or self-storage or parking lots or assisted living or those sorts of things. They've always done multifamily, and now all of a sudden they're saying, oh no, hotels are the next best thing, or residential assisted living is the next best thing. That worries me. That makes me wonder, is it that their multifamily deals are struggling and they don't want to keep doing that because they feel burned on it, and so they're just taking their reputation that they have and continuing to raise capital to go over to this other industry, versus if things are going well, right? If you know multifamily very well, for example, you know how to put deals together when the market is really good, and you know how to put even better deals together when the market is struggling because you have some level of excellence and expertise and connections. So that vague or shifting strategy, in my mind, would be a really big red flag to be considering right now. As with all of these things, there's nuance, right? In the worksheet, I tried to keep things like really simple, just, kind of simple words. And then here in our presentation, adding the nuance to it, that is not to say that someone can't do, multifamily for many years and then say, hey, my investor network is feeling a little over allocated to this. So I've gone out, I've met some people, and hey, let's do a hotel, right? That's not to say that that can't happen, but I would be very interested to ask them, why this asset class and why now, and how are your existing deals doing? And if what you're hearing is, our existing deals aren't doing so good, we're trying to, re-optimize, right? There's always like some opaque language. That would be a pretty big red flag to consider. Next up in our framework, let's go to analyzing the financial structure and projections. And I probably should have had this one, closer to the top. Let's talk about fees. If you take away one thing from this presentation, it is understanding the fees that are typical in this industry. This is a little bit of a soapbox area for me, and so I will try my very best to make sure that when I'm putting in any of my own like editorial that I disclaim that. It is very common. It is customary in this industry for a general partner to charge anywhere from about 4 to 7 fees. So this would be things like an acquisition fee, a financing fee, a management fee. That would be like an asset management fee separate from property management. Property management fee goes to the property manager. Maybe a construction fee or a renovation fee, a loan recourse fee, and then there's several other like less common fees. And most general partners will charge somewhere between like 3 and 5 of those fees. So they might have, say, a 1 to 2% acquisition fee. A disposition fee is also pretty common. So maybe a 1 to 2% acquisition fee and a 1% asset management fee and a 1% disposition fee. And they'll bury it somewhere deep in the PPM, deep in the presentation. And then in addition to that, they'll have their split. It's very, very, very important to understand fees. Let's take an acquisition fee, for example. An investor might think kind of quickly, right? Okay, I'm going to put $100,000 into this deal and there's a 1% acquisition fee. So $1,000 is going to the acquisition fee. That's not the way an acquisition fee works. An acquisition fee is based on the asset value. So let's say the raise is $10 million, and that is used to buy a $50 million asset with an 80% loan to value. Would be a very common number. The acquisition fee is not 1% of 10 million, it's 1% of 5 million. So it's actually a much larger raw percentage of the amount of capital that's raised. An asset management fee is typically 1% of rents collected, not 1% of profit, not 1% of the distributions, like 1% of just all revenue collected. And then a disposition fee is essentially calculated the same way as an acquisition fee. And fees almost always go first. They're taken off the top. Usually the day of closing, the general partner gets a pretty big check for their acquisition fee. And then the thing to think about here in terms of general partners meaningfully co-investing is very often a general partner will say, oh yeah, I'm putting, X hundreds of thousands or X millions of dollars in the deal. And really what they're doing is they're reinvesting their acquisition fee. So they're not actually putting capital in the deal. They're collecting an acquisition fee the day of closing and then immediately investing it in the deal. And I think I just get so frustrated with the opacity that's just so common in this industry. It is my belief, this is my editorial, this is not common in the industry. It is my belief that general partner level fees are an inherent disalignment between general partners and limited partners because general partners are compensated first and they're compensated in a way that's completely unavailable to the limited partners. The limited partners don't get a fee at the time of acquisition or they don't get a monthly asset management fee. It's something that's completely unavailable to them. One of my big missions across, my whole investing career is I would love to see the industry become so much less focused on general partner fees. In Black Swan, for example, we charge no fees whatsoever, and we only profit the same way our limited partners profit, which is from the actual profitability of the buildings. A portion of it goes to our limited partners, a portion of it goes to us, and that's it. We don't have this other stream of income that we can get. For a while, this was a very academic thing that my husband and I run our company together, Nick, that Nick and I would talk about for many, many years of how it was an inherent disalignment of incentives. And it was, just very risky that general partners could be compensated first before limited partners received their capital back and the returns that were projected. And then through the pandemic, we saw that happen. We saw general partners get millions of dollars in fees, the deal go under, partial or total loss of capital to the limited partners. But the general partner had collected those fees, years before, right, and had walked away with substantial profits. They may have taken, a very serious hit to their reputation, and maybe were never able to be, in this industry again because of that hit to their reputation. But they still were, profiting, 6 or 7 figures while losing, 7 or 8 figures of investor capital. So that's a real thing to think about. it's very unlikely you would find another general partner that charges no fees. So I'm not suggesting that you try to go out and find that because it's very unlikely. But ask about fees. Ask about the total fee load when those fees happen. Are those fees reimbursed if there's a capital call or partial or total capital loss, and really understanding that as much as possible. Just in the interest of time, we've already talked a little bit about debt, so we'll skip that one in part 4 here. In terms of red flags, we talked about fees there. Guaranteed returns, I have that in quotes there because that's a very specific word that's actually illegal in the industry. It is a worse practice as defined by the Securities and Exchange Commission. So if you ever see that word, that should be a complete non-starter, run in the other direction. There is no such thing as a guaranteed return in investing. Pretty much the only place you can get a guaranteed return is like a CD at an FDIC insured bank and maybe a US Treasury, depending on what you believe about the US government. You certainly cannot get a guaranteed return as a limited partner in any real estate investment. And then a red flag is complicated or opaque capital stacks. So a capital stack, if we think about a personal home that you might live in, is the bank gave you a mortgage, you brought the down payment, you own it, that's it. There's no other lenders, there's no other partners in that. In real estate, things can get very, very complicated. There can be, multiple layers of different types of investors, multiple layers of different types of debt. Some things to think about in 2025 is I would personally be very, very skittish of rescue capital. It's also called like recapitalization capital. And what that means is someone raised and acquired a deal, let's say in 2020, things aren't going as planned, they're out of money. They don't want to sell at a loss. They don't want to reveal to their investors that they've potentially lost capital. So they raise additional capital and they say, with this additional capital, we're going to do, these renovations or stabilize things or improve operations or cure vacancy, you name it. And in 3 years, when the market stabilizes, we'll sell the asset and rescue capital will be paid first. And then the common equity will be paid. I think this is a really shady way for general partners to prolong the death of deals in a way that looks like they're saving the deal, but really they're just prolonging, revealing to their original investors that it's very likely they've had a partial or total capital loss. So that's something I would be thinking about is why did the deal get to this place in the first place? Is there actually a business plan that actually makes sense, that makes it so that the rescue capital can be paid? And what would that mean to the common equity? And rescue capital is often somewhere between 10 and 13%, right? Think about even like your own life, right? If you were borrowing money at 13% to pay your own personal mortgage, that would probably put quite a pinch on your own finances. So that's something to think about as we go into 2026. We've already seen a lot of those deals in 2025 and more likely, to see more of them in the coming years. Be cautious on those. Number 5 is reviewing deal sourcing and underwriting. Understanding why is someone in that market? What are their relationships with brokers, with lenders, with property managers, maintenance, management, you name it. Really looking to see, do they have an actual relationship in this market? Or are they just chasing like, oh, it's in the Sun Belt, or it's in the Carolinas, or it's in Austin, or they're just chasing, a hot market name. Understand their due diligence. It's very unlikely as a limited partner that you will truly be able to make a reasoned assessment on specific numbers, right? Just like even as a physician, we don't understand exactly what all of the other specialists do, right? We have to trust in their expertise and the additional training that they've had, but understanding how they're making those decisions. It would be very unlikely that you would be able to pinpoint, say, what the exact rental rate is, right? Unless you're there in that market and you're secret shopping and you're looking at all the competitors and everything, very unlikely that you would know that, or very unlikely you would know, the exact maintenance costs for the elevator and all the mechanical systems and those sorts of things. But hearing how are they making those assessments? Do they have experience in that market before? Are they working with the same vendors that they've worked with for years and years and years across their other portfolio? And then most importantly, are there conservative assumptions? we saw in the last couple of years how much inflation has really challenged deals, let alone interest rates, and how much variable rate debt has crippled a lot of deals. Alone has been really challenging. So, do they have conservative assumptions in terms of both income growth, but then also expense maintenance and expense reduction? Look for aggressive underwriting, right? Look for things that just they don't make sense. It's all sunshine and rainbows. They're unable to answer challenging questions. They're assuming, staggering rent growth in a market that's been pretty steady, or very low vacancy in a market that currently has high vacancy. That would be pretty big red flags. And then we'll go into number 6. I'm trying to just speed up just a little bit since we're getting close to the top of the hour. Checking organizational capabilities and risk management. This one's pretty similar to number 2, where you're talking about team composition and expertise. What is the operations plan? I am a big believer that the general partner should be 1 hour or less from the deal, or visiting it at least once a quarter. Just the closer, the better, right? Boots on the ground. Same thing in medicine, right? You can read the chart, talk to the nurses, talk to the techs, all the things. You go lay eyes on the patient, your assessment changes in a hot second. It's the same thing in real estate. What is the operations plan? Who is there touching the asset? Who's working with the property manager? And by that, I mean the person that's running the asset day in and day out, that's meeting with residents, that's doing leasing showings, that's doing background screenings, handling maintenance tickets. That doesn't have to be the general partner themselves, right? Particularly if they're running, a larger portfolio. But what is their team for managing their boots on the ground staff? Talking about risk and mitigation. What are their reserves? How much capital do they plan to keep in reserve? Many operators will keep very little capital in reserve because then they need to raise less, right? There's just cash drag when you have a lot of capital reserves. But are they planning on reserves, right? Are they willing and able to raise a little bit more than they need to close on the deal so that they have those reserves in place? Because inevitably, things happen, right? Costs go up, insurance goes up, taxes go up, you name it. Red flags would be no risk, no mention of risk, unable to answer, those challenging questions on a due diligence call, unable to describe how they've handled risk in the past. In one of our quarterly reports, I believe it was Q2 of 2025, each quarter we do a full comprehensive quarterly report about the status of our entire portfolio. And I think it was Q2, it was either Q2 or Q3, but you can find it at blackswanteam.com/performance. It's where all of our quarterly updates are. We did a whole presentation on how we're managing risk, not just interest rate risk, but inflation, insurance, taxes, escalating cost of labor, escalating costs of materials and appliances, you name it, so that our investors know, like, these are the headwinds that we're running in every single day. And here's our decision-making algorithm of how we're dealing with that and how we plan to continue to deal with that in the future. So understanding how they handle decision-making. And then aggressive debt. I would be very wary of debt that comes from a debt fund. It's so not common sense. It can actually be very hard to kind of wrap your minds around. For most of us, when we think about debt, we think about, well, I'll go to the bank and I'll get a mortgage. And the mortgage doesn't want my house, right? They're in the business of collecting deposits and managing bank accounts and lending that money out. They're in the business of, collecting interest, and that's how they make profit. A debt fund is often in the business of owning assets, and they do it through debt. So they give more debt, riskier debt, higher interest rate, you name it, to deals that a typical bank won't lend on. And their real ultimate goal is to squeeze the general partner enough that they're able to seize the asset. They're in the business of being asset owners through the channel of first having debt on the property that's almost unserviceable, that's so predatory that then they're able to seize the asset. I would be very wary of investing in anything where a debt fund was involved because of that. And we've seen that unfold over the last many years. And then finally, we have reputation, transparency, and ongoing alignment. So this is where I would put those three things that I sketched out in the last couple minutes as I was preparing for our time is choosing someone who you really believe can be a steward of your capital, choosing someone whose decision-making algorithm you understand and believe in and can explain, and then choosing someone, and particularly a deal where you feel like there's alignment. I think the best way to find someone is through a referral, right? Just like in medicine, if you were looking for a specialist for your patients or for yourself, you would likely go to referral, right? It's unlikely you would go to Google and just, start finding someone cold. The warmer you are to that person, the better. Referrals, great. Having calls with them, attending their webinars, reading their emails, visiting them if possible. Once a year, we host an event for our existing investors, prospective investors, you name it. Everyone comes to Rochester, meets us, meets our team. We do some teaching about real estate investing and goals planning and what's the point of all of this, financial freedom. It's to live an amazing life. And then we go out and we tour the portfolio. That's pretty uncommon in the industry. Our investors love it. They love to see, I own a piece of this building. I understand this in such a different way than I'm able to get in just a Zoom call. And the investors that come back year after year after year, they see, oh, that used to be a field. Oh, now it's under construction. Oh, now it's a completed building and I'm walking through it. Pretty uncommon in the industry, but more and more, I would say groups are doing, investor dinners or tours of a community. At minimum, if you are investing with a general partner who invests with a larger firm, you want to make sure that general partner has walked the asset. You just want to point blank ask them, what's it like when you're there? Did you see it at night? Did you see it during the day? Did you meet the property manager? Did you meet some of the residents? The closer you are to the actual value that's being created, the better. Ask about their repeat investor rate, ask for an investor referral, ask about how often they do updates. And then I encourage that you follow someone, for a little while before you invest with them so that you can actually see their updates. What do their updates look like? How much information is included? Do they answer questions? It's a huge pet peeve of mine when general partners will do either their actual deal webinar or their performance updates and they don't take questions. Huge pet peeve of mine. Most of us can get by, doing an hour-long scripted presentation pretty easily. I want to know questions and I want to see how do they answer those questions. That goes back to thinking about their decision-making algorithm. Another investor may ask a question that, wasn't even on my consciousness. And I may not even necessarily care about that question, but I care, are they able to think in the moment? Do they clearly have, day-to-day expertise in this? Same as if you asked, a physician in another specialty, a question about, how do you take care of someone with this diagnosis? You want an answer right then and there. Not that you are testing them, but you want to know that they know it cold, right? That they can do it with their eyes closed, kind of that same thing there. Look for evasive answers. You'll sense it, right? Look for the legalese, look for the, I don't know, kind of business school speak, right? Look for that stuff, weed that stuff out aggressively, right? That probably means that someone has read some brochures and some offering memorandums and they don't actually have they've gotten their hands dirty, boots on the ground real estate investing experience. And then really look for GP heavy incentives, big acquisition fees, fees that come really early in the deal, ways that a general partner can be misaligned from their limited partners. There can be great people in this industry. I think it's because I'm a psychiatrist. I know that just humans are humans and we're motivated by rewards. And when there's rewards that are available for behavior that doesn't benefit the limited partners, like a big asset management fee or a big acquisition fee, that should be a red flag of, is this person really investing in this because they believe in it and they're going to steward my capital well and get the returns to me? Or are they encouraging me to invest in this because they're going to get a big acquisition fee right up front? All of that is there on your PDF. I popped it into the chat. I'll put it into the chat here again, just in case people have joined since I put that in a while ago. It'll be in the replay email as well. And then happy to take any questions that are coming up.
That, Elaine, was an awesome masterclass, and just totally like that should almost be required watching for anyone before they invest in a real estate deal. So I appreciate that so much. And the time you spent and going through and recording this with us and live with everyone here. Any questions from anyone in the audience, feel free, just unmute yourself or just pop them in the chat. Um, no, I think that was just incredible. What you spent a lot of time going through this. Can you just give us a quick couple minutes on again like your Black Swan sort of overlying principle and way of doing business and stuff like that, and then how people could reach out to you or find out about opportunities that you have?
Yeah, absolutely. So my husband and I built Black Swan Real Estate together. We started with our very first single family homes. I owned a home, he owned a home. We got married. We kept my home as a rental, found out we really liked it. And then one thing led to another. We started with a single family home portfolio. And then as we kind of, built that machine, we realized that we wanted to, build a bigger pipeline. And so then we started working with passive investors. As I mentioned earlier in the call, we did joint ventures for many years. All the way through, we have always managed our own properties. In that very first one, it was just like, well, I used to live in this house. I know it pretty well, so we'll self-manage it. And we really liked that. And we really felt like that was where the value comes from, is everything from making sure there's amazing marketing photos and the leasing process is smooth, all the way through maintenance and managing renewals and just the whole lifespan of that real estate investment. And so today, we have about 450 million in assets under management. It's about 2,500 doors. We are principally in Rochester, Minnesota, home of the Mayo Clinic, which is where my husband was born and raised and where I did my psychiatry residency. And then we stayed after that. And then we also have a small portion of our portfolio in Tacoma, Washington, so that we have some geographic and economic diversity. The fund that we have open right now is called our Secure Freedom Fund. The minimum investment is $25,000, investments of $1,000 increments thereafter. It pays a 10% fixed rate of return, and investors can elect if they would like to receive a monthly distribution if they're looking for cash flow, or to allow their distributions to reinvest and to compound monthly. And the benefit of that is a higher overall rate of return. So it goes up to 10.47 after 12 months, 11.5 after 24 months, 12.8 after 36 months, and kind of on from there. And really, when we created this fund, we were really thinking about, for each of those different levers, right? How much of the investment amount are there monthly distributions or not? When can investors exit the fund? We wanted investors to have a lot of control so that they can personalize their investment to their own goals inside of the larger fund. You can see all of that at securefreedomfund.com. The slide deck is there, our webinar, the actual paperwork, so that you could review that, share it with your attorney or CPA, whoever's important to you as you're making an investment decision. A link to my calendar, to block a time on my calendar. It's all kind of right there. At this particular moment, we're recording this, late December of 2025. The fund is closed for this tax year. I anticipate we'll open again in Q1 2026, probably somewhere around March, when we get our next acquisition under contract. And when we open, we often close very quickly. So we first open to our existing investors, then we open to our wait list, and then we open to the public. So I just absolutely hate like high pressure sales tactics and those sorts of things. So that's why we put everything on the website, have our calendars available. People can start to get our emails, come to our performance updates, get to know us. And then when we do open, they don't feel like they have to make a decision, right there, like in, just a couple of days, because they've had plenty of time to do that due diligence. And all of that is at securefreedomfund.com.
Amazing.
It is open only for accredited investors. It's a 506C.
Awesome. And I think that covers Jonathan's question well. Um,
Yeah.
Well, thank you all so much, and thank you, Elaine, for sharing your immense knowledge. Definitely, we'll get this recording up shortly and get this out to everyone. And thank you so much for your time, and everyone have a
Yeah.
good night and happy holidays.
Yeah. My pleasure. Thank you for having me. If anyone wants to block a time on my calendar, feel free to grab one. I'll be with the kids the next couple weeks with the holidays, but I have lots of times in January, and happy to answer any questions you have. Not just about our firm and investing with us, but I love educating people, and I don't know if it's like as I'm getting older or what, but I love protecting people, more and more. That's probably why when you mentioned this as the topic for tonight, I'm like, absolutely, we should talk about this. And I have such a different way of thinking about this. So I appreciate everyone listening to it and being open to, this different way of thinking about evaluating a general partner, and just appreciate the opportunity to be in community together.
Of course, absolutely. Well, everyone have a great night, and
Have a good night,
we'll see everyone
everyone.
soon.
Thank you guys.
Bye.
Have a good night.
Good night. You're welcome.